So I would like first to welcome all attendees on this session and my distinguished speakers as well. This conference is the third International Postgraduate Scientific Conference on Economics and Management. We have done it in the first year physically in Baku City, but unfortunately due to COVID cases, we are held the last 2 years. We are holding our conference virtually. And I would like just briefly explain the purpose of the conference and to introduce my speakers, and then we can pass to our today's session. The conference is organized by Azerbaijan State University of Economics and Ganja State Executive Power, and supported by Minister of Economy of Azerbaijan Republic and Minister of Education. And the general sponsorship has been done with Pasha Holding, which is a major conglomerate in Baku, Azerbaijan. So this year, we are holding our conference in Ganja City, which is the second biggest city of Azerbaijan. And 2021 declared as a year of Nizami Ganjavi in Azerbaijan. Nizami Ganjavi is a great poet of Azerbaijan. And this year also is the 88 years anniversary of this great poet in Azerbaijan. So this year we have over 700 junior researchers around the globe. They are presenting their papers, distinguished research papers in our conference. And we are having 16 workshops and over 70 research presentation sessions as well. So allow me to introduce my distinguished speakers today. My name is, first start by myself. My name is N.America. I am an instructor in Azerbaijan State University of Economics, and at the same time, I'm a senior trader at Azerbaijan State Oil Fund of Azerbaijan Republic. And I'm just working from 2017 in Azerbaijan State University of Economics and instructing corporate finance and investment portfolio management courses here. And my speakers today, I will start with Mike Hu, the general manager of Go Capital, which is one of the major real estate investment company in US, Europe, and APAC as well. And my second speaker is Anora NG, joining us from Hong Kong, also working for Go Capital Advisors in Hong Kong. And my third speaker is Jafar Islamli, is joining from Amsterdam, I believe, if I'm not mistaken, of, let's say, Netherlands. And he's also working in a venture capital company. And by the way, he's my former colleague from Sofas. So in today's session, we are gonna talk about impact of COVID on real estate on United States or North America, Europe, and Asia Pacific as well. And I would like to start with Mike Hu for my certain questions about the impact of COVID. Mike, what are the major impacts of COVID on real estate in US and different part of US, you might say, and different kinds of real estate sectors as well? Could you just briefly explain us?
Yeah, no, I think it's a really big question. I think that with COVID for us in the US here, the biggest impact was, to hospitality and to retail in terms of the most negative immediate impact. And I think that the reason why it was so dramatic was it was literally like the lights being turned off. And so everything got shut down, as we all know, and we all lived through. Travel stopped immediately. If you told anyone to run a downside scenario of an investment into a hotel and said, assume everything is going to get shut off and occupancy is going to basically go down to 10, 15%, I think anyone a few years ago would have said that's crazy, that this would never happen for such a long period of time too. So I think for us, we're seeing some of the headwinds were to specifically to hospitality and retail. I think initially, we're seeing some of the other impacts. I think are a little uncertain. For example, with office, I think we're going to have to see what will happen with office. We don't believe that office is going to completely go away. I think that you're seeing some companies right now where, they're still doing a work from home schedule, but I think they're starting to bring some people back. I believe that you are going to see a number of companies bring their employees back to the office in person starting in September after Labor Day. We're already seeing some companies enact sort of bringing their staff back. We are reopening things here in California. They're forcing or reopening things in mid-June. So our offices are officially reopening then. Although, some of us, including myself, I've been back in the office for a few months now. But I think we're starting to see some of those changes. And then you see some of the other sectors like logistics that have been very, very, I think already very hot because of the ongoing demand from e-commerce. And then a pickup in new classes such as data centers and also life science as well. So we're sort of, I would say COVID's really impacted these different sectors in different ways.
This is some overpriced kind of trend on those, because I know that especially in pandemic when it started at the end of 2019 and early 2020, there were a huge influx of capital into the logistics sectors. Don't you think that this could be a reason for some pricing issue on the sector?
Yeah, I do. I think that I think to your point, there's a lot of capital sort of rushing into certain sectors, and the ones that are getting sort of the most demand or the most interest right now in the U.S. are really, I would say, logistics and multifamily or for rental housing. That's really the bulk of a lot of capital. That's where most of it's going right now. And it's been very, very aggressive. So to your point, I would say, even though they're, probably still maybe the most, I would say, most resilient sectors, at least during COVID, a lot of those assets are getting bid up in terms of price right now. So we're seeing most of those assets that are being sold or portfolios that are being sold are being bid to sort of core plus type valuations to those buyers. So you're just seeing a lot of capital chasing very few deals. And I would say, at least from what we've seen here in the US, that a lot of those deals are getting bid up to the point where it really doesn't make a lot of sense, maybe for a lot of value add or opportunistic investors, unless they have core plus funds. So we're seeing sort of that shift now to other sectors, including office, retail, hospitality, which has been, I think, pretty attractive over the last couple of months as travels come back.
And the elephant in the room is actually obviously the retail, actually, because not only for COVID, actually pre-COVID also we were seeing some trends that especially e-commerce is just having a negative impact on retail, because people are more buying from certain portals, not to going to physical some retail stores. How do you see the future of retail? Under this, even after the impact after post-COVID, I mean.
Yeah, no, I think that retail, like you said, I think retail's had headwinds pre-COVID, right? It was already starting to suffer, especially in, I would say, class B, C type malls. They've really suffered already, and they were suffering even before COVID hit. I think our view is that the prime retail assets in these key gateway cities we're still seeing those actually show some pretty strong figures, and they're starting to rebound as people are starting to go out and shop again and travel again. We think that actually will hold up over time. But I think a lot of the big box retailers that, in some cities have been way overbuilt. We believe that some of that is going to get converted. And what will probably happen, which we think we could see play out over the next couple of years, would be taking the big box retailers and converting those into like a last mile logistics center, or even turn it into a center where maybe that's where the consumer goes to pick up their items. So for example, like most of us here in the US are ordering stuff through Amazon and it's delivered to our house, but there may be places where it can't be delivered, but you can show up at these areas and pick up your item. So that would be sort of like, it would help enable and reduce the cost for that last mile logistics center. And we think that some of that may happen as you see some of these retailers that have gone bankrupt, that are starting to give up that office space, or sorry, the existing retail space that they have that might get converted. But we're still seeing that the strongest retail is actually still doing pretty well, and we're seeing it pick back up pretty quickly. And so we don't see retail, going away. I don't think, even though e-commerce is really growing and it's still going to continue to grow, there's still a number of things that I think people do enjoy. They still, enjoy shopping if you can have the right experience. So that's why we think sort of experiential retail is something that still could be an interesting space to be in.
I see. Thanks, Mike. And let's a bit just change our focus to like economics. Recent major papers claims, and obvious statistics also shows that the inflation rate is hiking in the United States and in other parts of the world as well. And I believe in the last quarter it was over 4%. And inflation rate and real estate pricing, they have, in the basic real estate concept, we know that there's some correlation between these two. And how do you see this hiking inflationary rate is going to impact on real estate? Do you think that, the pricing of the real estate is also going to change under this condition?
Yeah, inflation is one of those tricky things that is very, very difficult to know what will fully trigger it and where it'll go. If you look at some of the facts right now, there's certain things that are becoming more expensive, right? The cost of shipping, lumber costs, steel costs, all these, key sort of commodities in the real estate industry are definitely going up. Even right now with like labor shortages, right? Like even in some of the hotels that we've seen, you can't get people to go back to work in some cities, right? So there's definitely an impact there. I think in the long run, though, it's hard to tell. To be completely honest, I think the honest answer is I don't know what's going to happen with inflation. I think that inflation is definitely starting to impact things right now. But what I don't know is it still going to happen in 12 to 18 months, or is this just a very temporary thing because of what's happened with COVID, people working from home, people being cautious right now. But then maybe in 12, 18, 24 months, maybe this fear of inflation that we're seeing right now, maybe it will subside and maybe it won't be as dramatic as what people think. I'm not sure. To be honest, I don't know the real answer. I think if I knew the answer, I would, wish I could look into that crystal ball. But I was speaking to Goodwin about this actually last week, he was in our LA office, our chairman. And he actually was saying that this is probably the most important thing that he's thinking about right now. So we're really thinking about this as a firm, trying to understand what is the impact of inflation and how will this impact us, because it can be positive, right, for real estate, in terms of, as you have rents go up too. But I think that for us, it's hard to know how long-term this really will be. Right now, I think there's a lot of headline risks and news that we're hearing about inflation, but I don't know that everyone is sure how permanent this will be.
Thank you, Mike. Thank you. Let's move a bit to European side, because I'm just planning actually in terms of real estate market, move from west to east actually. Like we have started with the US and now Europe, and then I will move to APEC side as well. And my guest, my speaker today is Jafar, joining us from Europe, more precise in Netherlands. Jafar, could you please just explain us overall economic, the situation in there? Because we are having so many news from Europe, and each day actually there are so many different news we are having. Well, on a certain day, I'm hearing I'm just reading very good, like positive news, but very recently I have started to read more negative news about European economy. And then what could you tell us about those stuff?
Thanks, Lemon, for the question. The first thing is about the the COVID crisis happening in Europe, I think it's the same thematic story for whole Europe, whole the world is that this crisis is more government-imposed crisis. So because of the COVID, governments like restricted everything, like people entering to every places, they have to sit home, they have to work from home. So this restriction brought the crisis to everywhere, and now the governments are dealing with a big deal in order to eliminate the side effects of the crisis. What's specifically happening in Europe is that people more or less working from home, they have some flexibility to go to the offices, and the policies are getting more accommodative. So the government's starting to stimulate the economy and businesses in order to help them to sustain their activities in this COVID crisis environment. The GDP growth is for whole Europe is something around standing at 5%, which is still lower than the pre-COVID levels, but it is a bit higher from the 2020 levels because there's a front-end optimism about the economy, and that is driving the trend growth rate higher, actually. And the investment activity is surprisingly increased. So it is standing around 200 billion euros in the Europe level, and most of it is falling on the benefit of the logistic investments. So very interesting thing about the economy is that now governments are keeping the expectations for the inflation level at around 2%. But for some of the countries, the negative interest rate environment is dominating still. For example, for Germany, it is standing at negative 0.5%. But if the optimistic expectations will fulfill sooner, they would turn into the positive interest rates, but they will still be lower and within the expected inflation level target of the European Central Bank. And for sure, if the stimulative or accommodative the policies will be fulfilled, the quantitative easing, the further quantitative easing by the ECB is inevitable for sure.
I see. You have just mentioned about negative interest rate in certain countries, and that I may assume there's a spread between like real estate returns and certain government fixed income products. The spread is just increasing between these two products. So under this situation, what do you see? I mean, the real estate expectation. What are the investment expectation of real estate, especially in like developed European markets, like Germany or as well? What's your expectation? What could you tell us about this?
Yeah, I think if you look at this from top to bottom, the big theme is for sure is e-commerce. So people staying at home, they started doing drop shipping activities. They're selling products through Amazon. They're earning some profits, and this e-commerce activity is growing at around 25%, 26%, which is 2 times higher than the pre-COVID levels. And this stand-alone businesses, they've grown so much enough that there's some companies, they got interested in buying these businesses. For example, there's a company in the US called Thrasio. They're buying Amazon businesses, and they have the similar competitors in Europe, like Celerix, Heroes. Now they're like private equity companies. They're buying Amazon businesses, and once they're buying these e-commerce companies, they're centralizing the logistics system, supply chain system, and everything related to the serving directly to the customer and last mile delivery to the customers. And this centralization have grown the demand for having the warehouse system, centralized warehouse system, logistics systems, because most of the products, they're being shipped from Asia because of being with the cheap labor cost and the lower cost of goods. and it's certainly grown the demand for the warehouses in Europe, and surprisingly, these places happened to be in Southern Europe, in Italy, in Spain, in Portugal, because they have the larger lands, the demand is higher, and this is driving the logistics asset demand in these countries. And if we can see, for example, the e-commerce per capita, it is higher for Germany, for Netherlands, for UK, and for France, for sure. So I think this is the big theme for the real estate market. The logistics assets are growing here. On the other side, the expectations for the office space, they're not evaporated at all, but tenants, they became more selective. So since all the companies, they went into the flexible working regime, now they actually saw that it is more effective working partly from home and partly from office. Now they're considering more the flexible office environment in Netherlands and in whole Europe as well. And they're giving more focus on the quality of the buildings. And that's why the prime yields, prime returns are still going to increase for the office assets. For the retail, it's a different story. And as Mike mentioned, the compression in the retail industry was still a big theme before the COVID crisis. And it's still happening in Europe as well, because of the growth in e-commerce. But what I see here is that people still enjoying the experience of going to shops, having the retail experience. And one interesting trend in Europe is that now most of the retailers, they're closing their small branches and giving focus to larger anchor branches, for example, within malls, because they want to give the full experience to the customers coming into their magazines. And some of them, they actually started to applying the interactive or different customer experience. So they're trying to switch the focus from brick and mortar to more digital in future. And what is happening for other asset classes? For example, there are some alternative asset classes are also becoming very popular. Already became very popular in Europe because of the COVID. There are lots of scientific researches are happening all over the places. There are lots of laboratories are opening of giving the corona test, for example, or doing some small researches. And governments like Netherlands and Germany, they are stimulating the entrepreneurs to build their own the research labs, their own startups, and that gave push to new asset classes like healthcare, real estate asset classes. Now they're also becoming a big theme in Europe, and lots of private equity funds and listed real estate companies, they're buying or they are investing in these asset classes as well.
Well, before starting our session, actually, we were discussing about, the COVID inoculation rate, like in different, like in US and UK, definitely inoculation rate is very high, actually, the people are getting vaccinated. I mean, So you were telling that, in Europe, it's a more in opposite situation as happening. Just around 4 or 5% of people so far got vaccinated. So, like under this, low rate of vaccination, how do you see, the impact on this low level of vaccination in the real estate side and overall economy as well? What's your expectation? Like, very short term. I'm not talking about the next 5 to 10 years, but very short term. I think what's going to happen in 2022 or 2023? What's your expectation under such conditions?
I think there are different behavioral sentiments among people. For example, in UK, the vaccination rate is over 14-20% right now. So So out of 100 people, like 40 is getting vaccinated. And based on that, is government planning to reopen all the places very soon. But in Europe, it's a different story. So it is below the 5% of the vaccination level. But even though that, the government, most of the governments are still going through the reopening schemes very soon. So the idea is that some people, they're believing that the vaccination will give way to the sooner economic growth. The other group of people, they're more learned to live with new normal. So they already accepted that the COVID, it is going to happen sooner or later. We have to learn how to live with that. And that somehow made them to be more adaptable to the new environment. So I think there are two opposed views in Europe is happening right now. And despite that opposition, I think the governments already thinking to go through the reopening, even though the vaccination is in lower rate, because they're believing that this is going to happen sooner or later.
I see. Thank you, Jafar. Thank you.
Thank you.
And I would like to move more COVID safest region, APAC, I would say, because we have seen that firstly in US, and at the beginning it was very low rate in US, of course, but in the later phases, like in the later phases of COVID crisis, we have seen a huge number of infection in the US, and even a fatality rate was also huge. And in Europe as well, in different parts of Europe, we have seen that crisis is really getting serious. But for APAC, I wouldn't say, but of course, maybe for certain regions, I'm just now excluding India and other regions from APAC in terms of the COVID crisis. But I'm specifically would like to just point out like China, Japan, Korea, Australia, New Zealand. Those regions really get very lowest impact from COVID. And my guest today is Anura N.G., which is a professional real estate investor in APAC region. So Anura, how about impact? Because we have just listened, Mike and Jafar, about impact of COVID on real estate. We would also like to listen to you about in terms of impact of COVID on real estate in APAC region.
Thank you, Neiman. Good morning, everyone from Hong Kong. And when Neiman pointed out that APAC is probably the safest region, I think it does come with a cost of how regulated everything is too. Before the conference, we were just saying how we've been in Hong Kong for over a year now, which is unprecedented given our work schedule that requires us to travel a lot. The restrictions on traveling outside and coming back in with a 21 days quarantine, it really helps contain COVID, but at the same time, it has a lot of other economic implications as well. Let's take Hong Kong, for example. Usually we have over 55 million visitors each day. And today we're talking about like 20-something thousand. But when you turn and look into mainland China, it is still very restricted in a sense, but because the scale of the country is so much bigger than a Chinese city like Hong Kong, then you'll see actually a boom in domestic travels. Especially when people are not as incentivized to like travel to Europe, travel to the US, given the restrictions. So this year, we actually have been seeing a lot of domestic consumption. I mean, it has been a trend, even pre-COVID, that China's economic engine is fueled by domestic consumption, but it's been even more accelerated by COVID. And one of the byproducts, similar to what Jafar mentioned in Europe, is actually e-commerce. Now, e-commerce has always been a big part of China. Like Neiman, you are very familiar with mainland China as well, because you've traveled there multiple times, and you probably have experienced yourself that, like, as a foreigner, if you don't have the Chinese apps, it's almost impossible to get a taxi, because everyone relies on the ride-hailing apps. Literally, if you go on the street and pay cash, people won't take your money anymore, because everything's relying on e-commerce. And over COVID, I think what we observed on the ground is it got even accelerated even more to a wider population group, including some of the more elderly group types, because a lot of people start ordering food and groceries to home to minimize communication with outside. And in general, we see that across Asia Pacific as well. So that's why how it connects back to Jafar's point of how logistics is actually really on the switch. And we do continue to see the growth in cold storage, last mile logistics in Asia. And ourselves, we have invested into a lot of China logistics, Australia logistics, and Vietnam logistics. And speaking of Vietnam, it's actually a very interesting market that we see. And it is quite reliant on foreign capital. But at the same time, the rising middle class and the booming economy, you can see that it is still ongoing even post-COVID times. Although the hospitality industry has been hard hit, as with anywhere else in the world, and it's increasingly salient for economies, even developing economies that's very reliant on outside injection of foreign capital to turn that into something profitable looking within the country. And one sector that we find very interesting is in the internet data centers. I think one other
correct.
factor that changed.
Yeah, correct. Yeah, correct. I'm sorry for interruption. I was about to ask this question actually, because I will back to Mike and Jafar as well in terms of, because data centers, like this, especially after COVID, I just all my speakers mentioned, more and more people are just using their mobile phone or other medium stuff to just to order their daily food, even other stuff as well. So the demand is just, I believe, increasing, and I've heard that you have as a goal also start to make an investment in internet data centers. So APAC is very diverse. Could you just briefly explain your data set? What major cities are the hub for data centers, and what are the major demand factors, and what's your expectation from the sector?
Right, maybe I'll keep it short and then pass it to Mike and Jafar. But for internet data centers, because we're covering a lot of regions in APAC, because ourselves, when we look at data centers, I think because it's such a regulated industry as well, especially on the data privacy. For example, in mainland China, you definitely need to have a domestic data center in order to process anything within mainland China. So it's very interesting how the supply is really controlled by the provision of electricity or the carbon emission quota. And then when you look into other countries within APAC also, you'll see a little bit more collaboration there. For example, in Singapore, there's a moratorium because especially after COVID, everyone, currently we're actually using a lot of data. You're doing this live session on Zoom, and everyone else is doing that too. So this sudden burst of demand, which was there already pre-COVID times, but post-COVID has been accelerated so much faster, makes a lot of countries realize that, oh, maybe the supply is not catching up with the demand. So governments like Singapore are exploring with Malaysia, exploring with Indonesia to find other sites to provide data centers and data usage towards Singapore. I'll stop there.
Okay, I have one more question. This question specifically goes to Anore and Mike, because, you know, from geopolitical perspective, I'm asking Europe, it seems that Europe is a bit more neutral, but very, like, you know, last year, at the recent months of Trump, we have seen a huge, intense, you know, serious relationship between the US and China. Still, at the early period of Biden, we have seen that still the relationship hasn't been cooling down. So what's your expectation from this? Because, you know, geopolitical factors obviously have an impact on, like, overall economy and real estate sector as well. So starting with you, Mike, what's your expectation from this geopolitical stuff? You know, how it's going to impact?
Yeah, it's a big question. I think that everyone's been watching to see how Biden would sort of react to China as sort of a growing number two, right, to the U.S. And obviously, I think, you know, Trump's administration took certain more, I would say, adversarial and a more aggressive approach to China with tariffs, et cetera, and the trade war. I think that, but to be honest, I think that when we look at it, I think the U.S.-China trade war and tension is something that's still going to be around, and it's something that we're all going to have to learn to sort of accept and deal with. I think that what we want to see is how this will play out over the course of Biden's administration, and also how this could roll into other sectors, and then how this could impact the real estate sector. So, for example, you know, we're starting to see what Biden is going to do right now in terms of how he wants to react to the growing presence of, you know, China's, I would say, in terms of their impact on other countries within APAC. And I think that the U.S. has to sort of decide where they want to play and how they want to play, you know, in terms of that relationship. I think that our view, though, is, you know, this is something that you're going to have to wait and see, and this tension is not going to go away. So I think there were some people that thought that Biden would ease up on a lot of the restrictions, but we're seeing that he obviously is not doing that. I think that their administration, the Biden administration, is still going to be, you know, fairly firm with China. So I think that you'll still see some of that tension. So it could go back and forth, but it's something that we're monitoring. But the one thing I would say that's interesting about that dynamic is it's going to create like a bifurcation between sort of the US and China, in that you'll have sort of a Western-led you know, ally group led by the U.S., and then you're going to have a China-led portion out of Asia with sort of a bifurcation between these two regions. And we actually think that may be interesting for global investors, because you want to actually have an allocation to both sides, because they will be less correlated with each other. And we think that there's no doubt that the U.S. and China are still going to be very good areas to invest in. And there are going to be a number of interesting opportunities, just obviously being sort of the number 1 and 2 largest economies in the world. But we're looking at that. And we've actually seen a number of our investors, to be honest, that have been quite, I would say, cautious on China and investing in China, that are starting to actually allocate more dollars to opportunities in China and other parts of APAC. So we actually think this actually could be interesting and may benefit investment into the region, even though it's creating more geopolitical risk in the near term.
What do you think, Anura, about since you are based in Hong Kong? That's what we have listened. Mike is like based in California. What's your expectation?
Yeah, so I do agree with Mike, especially on the point when he said that he sees how some of the U.S. capital is now more wary into going into China specifically, and in our private equity real estate investment space, where we see our investors' capital flows. We also noticed that a bigger pie of the investments into mainland China is from the Middle East, from North Asia and South Asia, and less so from the US. Canadian capital is also still moving more allocation to Asia and part of it into mainland China. But I think especially pre-Biden times, there was a very stark impact in pension funds in the US getting their capital across to mainland China.
Mm-hmm. So talking about political factors, I would like to ask Jafar, because we have witnessed Brexit, like, UK is already this process finalized. What do you see, like, after Brexit have already done? How the market looks like now? Do you think that more capital is coming from London to, let's say, to other part of Europe, or the things are same like before Brexit? How do you see the market now, especially after Brexit?
I think one thing that both UK and Europe is in one page is the relationship with the Asian investors, for sure, because before the Brexit and after the Brexit, both of these countries are having the influx of capital coming from the East. For sure, and this is going to be dominating the whole European market in future as well. What is specifically for the Brexit is that the Brexit caused the stagnation for the UK in terms of international trade relationships, because they didn't have a certain understanding of how this relationship will continue with Europe and with whole world, especially with the US, with China and other big countries. But now this is getting better and better because after the Brexit, now the UK have more certain the understanding and treatments with Europe, with investors from Japan and from China specifically, and that positive sentiment is growing all across the UK, and that is already happening in this country. And the one thing that you can't throw it away is the relationship with Europe that is standing with a history of more than 50 years, and you can't just cut it back. And that's why the one important thing is how UK will retain relationship, in which form the UK will retain relationships with Europe. In terms of the financial industry, there is a huge flow of big companies and the trade venues from London to other major European cities like Amsterdam, Frankfurt, and Paris. So the Amsterdam is the one is the closest to London, and logically could be the one place that's getting exposure to the financial industry. But even Dutch government is being scared of the scale of operations that will be coming to Amsterdam, that they couldn't cope with that scale in shorter future. So it is inevitable that the financial center will switch from London to Europe, but London will still keep its own stake. For example, they recently adopted a new trading regulation that has been adhered in Switzerland. So there will be the major trade venues, London with Geneva, to dominate some portion of transactions and trading activities happening here. but the role of Europe for the UK specifically is in terms of logistics, because their largest ports closest to UK is located in Europe, and specifically in Rotterdam. Rotterdam port is one of the important logistic space for the UK in terms of the trade goods coming to that area and then moving to the UK. I think there are lots of bilateral relationships and roles and expectations between UK and European countries, European countries, sir.
Thank you, Jafar. Thank you. I have just received a question. In fact, it's a two-part question. I would like to ask my speakers and my guests here. The first part of the question says that, what do you think? Why the COVID crisis increased income inequality? Maybe it's not directly related to real estate, but it's with our overall economic view. I would like to start to ask you, Mike, what do you think? Why might one of our attendees asking why COVID increased income inequality?
Yeah, I think it's a really good question. I think that at least here in the U.S., you can really see why it sort of exacerbated what was already happening, and I believe it widened income inequality, because if you think about the people that were considered essential workers, right? The people that have to go to work, whether it be doctors, teachers, grocery workers, the post office, etc. They were considered essential workers and still had to go to work. And what I realize is that a lot of people that are, let's say, whether it's in finance or in sort of IT and more technical jobs that could actually work remotely, those jobs actually could still sort of work remotely, and for the last 15 months could be able to survive doing that. And oftentimes they're actually compensated more, right, in a lot of those fields. And so what we've seen is that's I believe that's widened that, because a lot of people that had to go into the office had to go into their job. So let's say they were working in a grocery store and didn't have a choice. What did they have to do if they have children, right? Or other people to take care of? Because I think for like myself, I've got 3 young kids. Our schools were closed, right? So there was a point in time where our schools were completely closed. Everything was remote, but you still had to work. And so you still have to go to, buy groceries. You still have to manage. And it didn't allow, I believe it did not allow a lot of people that had to go to work and still be somewhere from call it a 8 to 6 type job and go there. But then meanwhile, they still have to take care of their responsibilities, but the schools may be closed and they're unable to fulfill that. So I believe that really widened that gap, the income inequality, and exacerbated that issue. And so you're seeing some of that really play out, I think, here in the US. I think that's actually going to continue to be a real problem. And that's also why I think the government had stepped in with the stimulus checks, because they noticed that this was making it very, very difficult for people to get by. So they wanted to provide some sort of help, which I think was the right thing to do. But in some cases, it's difficult because there were some people that actually made as much money or more money by not working, and instead of going back to work. So I think that also created some other unintended consequences. So right now, the U.S. is sort of going through that right now. So that's why, as I mentioned earlier, it's actually difficult to get some people back to work at some restaurants and hotels, because it's right now they've shown that some people are actually getting paid just as much money by not working if they continue to receive those stimulus checks. So that's something the government has to figure out and resolve.
Correct. Thanks, Mike. And, as a second part of the question, we have seen that, especially in US, actually, we have PPP structure, which government, have a stimulating market. Actually, they have allocated certain capital into the market, but still, some of my attendees are like thinking that still big companies, like they are doing well, but also government had a like PPP structure. Still, the SME, small and medium enterprises are struggling. I mean, what could be done in that sense? Actually, how, because to stimulate those stuff.
And sorry, how to stimulate?
I mean, just
PPP.
No, not PPP. I mean, my attendee's question was that still statistics shows that bigger companies such as big corporations are doing well. Actually, they have hit, of course, from COVID, but even also government through PPP structure, allocate capital to small and medium enterprises in the United States. But still, statistics shows that more and more SMEs are closing down. They are still unprofitable. I mean, what can be done on that? I mean, what's the reason? Actually, they would like to
know. I think that part of it is there were some. I think that there were some small and medium-sized enterprises that just really. I think it was COVID was too long of an impact for some of those businesses. So I think that had it been sort of a quick shutdown and everything came back online, maybe more like what Anora described with Asia, where it was more of I would say Asia did a really good job of sort of managing the impact of COVID and then bringing everything back online. I think if it was something shorter in duration, it would not have been as severe as what we've seen here in the U.S. I think with the U.S., to be completely candid, I think that most of these smaller businesses, they just don't have enough of just sort of a cash supply or reserve to be able to ride it through 12 to 15 months of no business or very little business. And I think that that's something that we've seen. Unfortunately, I mean, I've seen it even in my neighborhood with some restaurants, right? And some boutique shops where it's very difficult because they have to either negotiate for some sort of forbearance or try to raise additional capital. And a lot of the smaller businesses have a very difficult time doing that. So I think, unfortunately, a lot of them, even if they got stimulus checks or PPP funds or other things, it just wasn't enough. And I think that's where I think COVID, going back to your initial question, I think it sort of widened that inequality gap because it didn't help, right? Versus, like you said, some of the big companies, right? The Fortune 10 companies of the world, from the Amazons, Googles, et cetera, they've actually just thrived, right? A lot of them have done even better during COVID. And part of that's, I think it was already happening and we're seeing that sort of shift. But one thing actually I would say that I think is interesting is what you described earlier is in Asia, they did an incredible job of shutting things down and managing COVID. I think the US and Europe, we did not do a great job, to be honest, of managing COVID. So here in the US, we had, incredible cases. But one thing I have seen is in the last couple months, the vaccine rollout has actually been very strong here in the States. And I do think that actually is going to benefit us in the future. And I think actually in the next sort of 12 to 18, 24 months, I could see that the US actually may grow, much faster than we anticipated, because we're seeing it in the data. When we look at our hotels across the office sector, in the areas that we invest in, we've seen a lot of that really come back much faster than we expected over the last 3-4 months. And so every week as we look at the data, I've seen it get better and better. So I'm becoming more and more optimistic than if you asked me this 3 or 4 months ago. I would say, hey, I was not that optimistic, but things are looking better.
Sure.
I think to support Mike, what I can say is that the COVID came with the with a shock embedded on that. So nobody expected what's going to happen, how to react. But at the same time, we have to understand that the survival rate among small and medium enterprises, they have always been lower. So for them to turn into the big companies, it took a long, and it took the specific steps and specific actions, like being more flexible, more adaptable, more having customer awareness, client awareness. I think these factors, they haven't evaporated. They're still in this place, and I think this is the good challenge for the companies to just filter out, and that's what the small and medium companies are facing right now. And I think regardless how much government spends as a stimulative package for these companies, I think the philosophy and the quality of the companies will tell in the future, or at the end of the day, that how or whether they will survive or not.
Yeah, and then I think to add on to that, it's there's another division other than like bigger companies versus SMEs, but also like the different sectors. Like here we see that especially hotel, retail, service sectors are severely impacted. Even after there are some regulations trying to lock down and trying to contain COVID, but it itself has its own economic impacts as well, because a lot of people have lost their jobs because the capacity have been scaled down. So I think one thing that COVID really accelerated the divide is skilled labor versus not as skilled labor. Those who need to be physical in their presence on their jobs versus people who can work remotely, like Mike mentioned. So and in a way, there's a increasing technology gap as well. Those who have access to technology versus those who have not. Because last year we were doing a fundraise for our high school alum group to lower income group class children. And you'll see significantly that there's a huge need to upgrade the technology, be it having an iPad or having a computer, because without that, you won't even have access to quality education. And in terms of like living in a small space, doing the Zoom classes, or having parents' guidance or help to get them to focus on their education versus some wealthier families. It's a complete different learning environment. So I think COVID did really accelerate that gap, and hopefully in the near future that one can be mitigated when things go back to normal.
Thank you very much.
Yeah.
Thank you very much. As we are approaching to the end of our today's session, I would like to thank all of to my distinguished speakers, Mike Hu, joined us from California as General Manager of Go Capital Investor Advisors. Andora joined us from Hong Kong, also representing of Go Capital. And Jafar joined us from Netherlands, from a venture capital company. Thank you very much. I really appreciate for your participation, and I also would like to appreciate our attendees today. If you guys have any question to me, I'm open to ask. Otherwise, we can just finalize our today's session.
Thanks, Neman.
Thank you, Neman.
Thank you.
Thanks, Neman. Thanks for organizing a global panel here, and hopefully you have a pop quiz for your students.
Thank you. It's a very good, informative session for our students as well, and I do hope that I will see you on our next conference, which I hope is going to be physical, not like virtual one. In Baku, we are expecting next year around this time. But I will definitely invite you once, it started next year.